Welcome to you all for day 2 of the ABARES Outlook 2024. And we kick off the day with a very interesting discussion, very, very timely. I think it sort of goes into the detail about what is the overall theme: farm debt, investment and resilience. So the session will focus on farm business risk, including drought risk, which was just around the corner, then sort of disappeared and then, maybe comes back, although La Nina is forecast. All very uncertain. It's a period of high interest rates, high relative interest rates compared to the last 3 or 4 years, and the impact on investment in the sector. So a longer term issue relates to the pricing of climate risk in agriculture through impacts on debt and other sources of capital, such as corporate sector investment. So we will have a scene set from Dr. Neil Hughes, and we will follow Neil with a short introduction from our speakers, which will give us time to take your questions if you write them on your app. You can also tweet. Turn your mobile phone to silent, but tweet and interact using the hashtag ABARES Outlook, as you can see on the display. So get your questions ready, including those of you watching remotely as well, online. So, welcome. I am Serena Locke. I have been with the ABC since 1991. I had a 3-year break while I was in the UK reporting on environmental issues in 1998 and 99, and I was roaming around the countryside reporting on wave energy and wind energy and renewable energy in the late 90s, and I think I was very frustrated to come home to Australia and find that there wasn't a lot of discussion at the highest political levels about how to solve the climate issues, and it's great that we are seeing that action now. After about 30 years, I'm leaving the area of reporting, and I am going to farm on our farm at Holbrook. We have beef cattle, but our passion projects are the environment and the creek line and revegetation and saving what's there of the waterways. So I have an investment in these discussions that I'm chairing today. So excuse me for that, but I think it puts me in an interesting position. So let me introduce our first speaker. Neil is a senior economist at ABARES. You will know him if you've been to ABARES before, and an adjunct associate professor at Deakin University. He has a wealth of experience with 17 years as a research economist at ABARES and a focus on water policy in the Murray-Darling Basin and the effects of drought and climate change on Australian farms. Please welcome Dr. Hughes to address the farm risk, debt and investment trends and risk management practices. Thank you.
Hello everybody. So you will have seen this chart yesterday. Kind of shows you don't have to look very far back in time to see the effects of risk in agriculture. This is average farm cash income and profit for broadacre farms. You see a really big drop this financial year in profitability, lower livestock prices, dry conditions, following some extremely good years, which themselves followed some of the worst droughts that we'd seen back in 2019, 2020. So there's 2 main drivers of that risk, and that's weather conditions and prices, both of which are well outside the control of farmers. Some of the modelling at ABARES allows us to separate the effects of the weather conditions from the prices to look at what that's doing on average across the broadacre farm sector. So that chart's showing you the effect of climate conditions over the last 30 years. And you can see there's a bit of it's a bit asymmetric, so it's a bit more downside risk in those drought years. Then you get upside, and then you can see the price effects. And you can see just how good some of those years were in recent times and how things have kind of come right back down. And you take those 2 factors together and you get a whole lot of variation. So those numbers, they really understate the effect of risk. So that's looking at volatility at an average level across the whole broadacre sector. But for individual farm businesses, they face a lot more risk than that. So this chart's showing you the variation in the profits for a typical livestock farm and a typical cropping farm. This is looking just solely at the effects of weather conditions. So that line around zero is showing you that's profits in a kind of normal average year, and then percentage changes around that up towards kind of plus 50% for a cropping farm in the best year, and down near minus 100%, meaning no profit at all and in danger of losing money. You can see the cropping farms face more climate risk than livestock sector. Livestock sector has a bit more flexibility to increase turn-off and to bring in feed and things like that than you can do in the cropping sector. But once you add in the price risk, it kind of really flips around. So the livestock sector is kind of uniquely exposed to commodity price changes. If you look at industries like beef, then there's a lack of diversification. Beef farms tend to be concentrated in beef and have most of their revenue tied up in that. So they are very exposed to fluctuations in sale yard prices, and we've seen the effects of that in the current season. So here is a map showing how that risk varies across location. I apologise, these slides are a little bit stretched, but hopefully you can make all of that out. So this is showing how climate risk varies at different locations. So it's important to stress that all areas of farming in Australia are subject to climate risk, and we're just showing you higher and lower risk areas. We tend to see the highest risk in sort of the more marginal areas of the cropping zone. So climate risk is a function of both the sensitivity of the farms, so if they're engaged in cropping and they're more sensitive to climate, and the exposure, basically how variable rainfall is. So areas like the northern part of the WA cropping zone have both high sensitivity and exposure and come up as red. And the pattern changes a little bit once you overlay the price risk and you start seeing there's a little bit more risk in some of those livestock dominated areas, in areas on the coast where the climate variability is not particularly high, but they face a lot of price risk. So general story over the last 30 or so years is that risk has been increasing. So we know that climate change is happening. If we look at the evidence, both the observed climate record and the projection data, on balance, we are seeing and expecting not just conditions to get tougher on average, hotter and drier, but more volatility and more extremes. And then on the price side, we know that over the last 50 or so years, agriculture has seen a lot of deregulation. Now the industry is very much exposed to international fluctuations in commodity markets. And if the experience of the last few years with wars and pandemics and all of these things going on is anything to go by, there's been no slowdown in the amount of global volatility in agricultural commodity markets. So how do farmers deal with this? Well, the primary way they deal with it is by maintaining a very healthy balance sheet. So this data is from ABARES Farm Survey, shows equity rates on average for broadacre farmers hovering around 90%. They've actually picked up, at least up until 2022, based on a bit of a recent run-up in land prices. But they've never really varied a whole lot from that level. If you look at a typical medium-sized broadacre farm, they're holding debt of around $250,000, and in 2022 that was less than their annual revenue, and they're holding about the same amount of money in liquid assets. So they're facing a lot of risk in their production system and a lot of risk in their income, but they're managing that by not taking on any financial risk and holding very high equity. So while farms maintain that healthy balance sheet, they're still exposed to a lot of risk, and that risk matters. It has costs. Risk is a constraint on productivity in the industry, it's a constraint on investment. If there was a costless way to remove risk in the agricultural sector, there would be great benefits for farmers and for the industry. But there isn't. Risk management is hard, it's complicated, and it's costly. From my perspective as an economist, insurance would be a really clean solution to the problem of risk in agriculture. but we're a long way from kind of solving the problem of having viable insurance markets for things like drought risk in particular. So there's a range of different risk management approaches, both private and public, and they all have their different costs and benefits, and we're going to hear a bit more about them in today's session. So lastly, I just wanted to talk about risk from the industry perspective. So we're often focusing on the individual farm businesses and the risk that they face, but there's a limit to what you can do on farm, and unavoidably there's going to be risk in industry production, which potentially has consequences for consumers and for downstream sectors. So we all know the story of bananas, where cyclones have wiped out whole crops and led to big spikes in the price. But even for commodities like grain, where we produce a lot more than we consume and we export large amounts in most years, we can, in extreme droughts, have shortages and spikes in the price, and even get to the point where we're starting to import various amounts of grain. So these things matter. They impact consumers, they impact other aspects of the agricultural sector, particularly in the case of grain intensive livestock. So it's useful to look at risk not just from a farm perspective, but this system-wide industry perspective, and think about what governments and industry can do to prepare for these kinds of events. So that means there's different policy levers that involved there. So it's things like biosecurity, trade and market access, supply chains, infrastructure, and thinking about what governments and industry can do to prepare for those really extreme large events, because we know that with climate change it's possible that we may get them more often. And so just lastly, just acknowledging that a lot of the numbers and the modelling I'm showing you today coming from ABARES Farm Predict work, and also our partnership with the CSIRO on the Drought Early Warning System project. So there's going to be more information coming out very soon. Hopefully later this month we'll be putting out a report kind of describing some of this stuff, and hopefully you'll see a bit more of it around. But if you've got any more questions, I'm happy to take them on that later. Thanks.
Do you have a seat up there? Oh, you do? Okay. So what we're going to do now is go to the panel, and I'll introduce them all. Then they'll give their opening talk, which is going to be quite short, and then we'll open up the floor so that we have quite a lot of time dedicated to the questions. So first on our panel we have Josie Sill. Now, Josie is an agribusiness professional, blending her roles as the National Australia Bank's agribusiness executive and as a beef farmer, and we're just having a natter about that outside. She has a passion for sustainable farming practices and climate resilience. She's down in Gippsland, Victoria. She'll outline the 101 of funding agricultural entities and financing the farm. Melissa Brown, next to Josie, has been in the ag portfolio for over 30 years, and her passion started young, growing up on a cattle farm in the Snowy Mountains. She is highly experienced in natural resource management and in fisheries, including heading international negotiations on tuna management, which must have been extraordinary time. Agricultural policy, regulation and biosecurity. She's covered it all. John Howard came to the Regional Investment Corporation as CEO in time to oversee the transition from a third-party management of lending services to a fully integrated, in-sourced model with direct ownership of customer relations. And before coming to government, provider of low-interest loans for farm businesses, he had extensive private sector experience, successfully transitioning and diversifying the peanut company, which resulted in its sale to Bega Cheese. I thought I might mention that. It's a very interesting background. And finally, our panellist is Christina Hermansen, Managing Director of Asia Pacific Region and Africa of Nuveen Capital. Now, she targets growth in the region in farmland, timber and nature-based investments in collaboration with the expertise across Nuveen She was raised on a Wisconsin dairy farm, so you'll hear that accent, but she's very much Australian. She's been 25 years in international leadership, including in Australia and Europe, and most recently at FMC Corporation, and prior leadership roles were at Archer Daniels Midland, ADM, and Coca-Cola Amatil. So I would ask the panellists to give their opening address and then pass on, tag team, and then we'll open up for questions.
Thanks.
And the clicker.
Thanks very much. Thanks very much, everybody. So somebody asked me yesterday why banks are so interested in climate and in carbon. And as we know, we've just seen agribusinesses are highly dependent on the weather. And so if we've got a strong customer base, we're going to have a strong bank. So NAB are a large player in the agribusiness sector. We've got 30% market share. And so when it comes to risk in agriculture and opportunity, we're at the table. So like any organisation who's working in a specialised sector, we need to have a strong understanding of the risks and opportunities, and we need to be in a position to advocate and have policies and products and an investment strategy that will support our customers. So the fundamentals of banking and the way that we consider risk, for any seasoned banker in the room who might know this as well, it's the 3 C's of credit. It's about character, collateral and capacity. Character, it's about the management capability of the borrower, their track record and their experience. Collateral, the quality of the farming asset, its use, the infrastructure on it and its value. And capacity is capacity to repay debt, the quantity and quality of the commodity produced, the selling strategy, price and timing. So these 3 C's help us to understand the risks and mitigants in the businesses that we bank. And as we move forward through a changing climate, we're starting to see new themes emerge in our 3 C's. Farmers are adapting to physical risks that they're experiencing. They're thinking about managing severe weather conditions. We're seeing people respond quickly and early. We're seeing active management of dry times, which comes for planning of bridging of feed gaps and dealing with low soil moisture, but also high rainfall events and opportunistic plantings. We're seeing farmers consider transition risks, looking at long-term strategies such as land use change and technology to adapt their farming business. Farmers are considering their supply chain and consumer preferences. And we're even seeing farmers entering into carbon farming projects. So we as a bank need to be in a position to understand a new set of risks here, such as preserving the asset, measuring the income, and the opportunities that come with these diversified revenue streams. Some of these adaptation strategies can have a really quick payback and they're funded out of cash flow. But some of them can be quite capital intensive and will take a longer time to pay back. And that's where the bank can come in to help. So how do we support our customers through the transition? First of all, it's about building our own knowledge and capability. We are not farmers, we're not scientists or researchers. We're bankers, but we listen and we learn from the best, many of you in the room. We've developed climate training with the University of Melbourne and the Melbourne Business School so we can equip ourselves to understand what this looks like. We fund the transition on farm through green loans, and we can which preferentially price for climate adaptation and decarbonisation activities. We fund research which helps us understand some of these on-farm impacts, such as with Farming for the Future, who we heard from yesterday, and also Deloitte Access Economics, who've researched the cost of decarbonisation to the economy, but also the economic benefit of the transition. NAB's also partnering and investing out in the marketplace to build technical capability to measure and monitor. So at the end of the day, we're here to participate in a strong ag sector. We have a role to support customers to be climate and supply chain ready. Thank you.
It's there.
Hi everyone, morning. As it was announced, I'm Mel Brown from the Department of Agriculture, Fisheries and Forestry. So my division is responsible for farm resilience. So it captures many things, including the Future Drought Fund, Farm Household Allowance. We work closely with John in terms of the Regional Investment Corporation, which he'll talk through in that sense. And we also have the Rural Financial Counselling Service that sits within the division. So while the word resilience is not the most popular with everyone, I think the concept behind it is really critical and will become a mainstay of the Australian agriculture sector. As it was mentioned, I grew up on a cattle farm in the Snowy Mountains, and many years ago when I was a teenager, kind of wasn't really the word around was resilience and adaptation, but when I look back at when we had really tough winter seasons of snow, we were having to be resilient. We were getting food in, fodder, feeding the cattle. We then go into the spring months and we deal with wild dogs coming off the Kosciuszko National Park and terrorising sheep that we had at the time. So we had to adapt and change our farming practices, which is what we're really concentrating on within my division, within the department, and what the government's delivering. So really, Australian farmers are some of the best in the world, and they're some of the best innovators and adapters, and are constantly improving the way they manage drought. The approach must continue, particularly because the effect of climate change, and interestingly felt by the agriculture and sectors across regional Australia. As policymakers, we see many diverse farms, and we look at our role as supporting this adaptation and help build resilience, not only financially, economic and social resilience. So as Josie mentioned, she has the 3 Cs. We work on the 2 Cs. So resilience is underpinned by both a farmer's financial capacity and their capability. So capacity is having the resources and infrastructure to draw upon if needed. So this is really around including the equity or cash reserves that they have, or access to finance from a bank or a family member. In terms of capability, this is around the farmer's knowledge, their skills and experience. It is their managerial skills and their ability that they pull the required resources that they need at the right time. So for example, do they have a drought plan? Can they readily access sound advice when needed? And do they know what government resources are available to them? So better resilience outcomes are likely if a farm business has both the capacity and the capability to get through difficult times. Neil mentioned the Farm Household Allowance program in his presentation. Many people really see this as just an income support payment, but it's much more than that. It actually offers up a $10,000 grant for people that are on Farm Household Allowance to participate and get professional advice. And we've seen this through a number of examples, but one I'll just mention is around a producer that spent $950 on a conference in the flower industry. So their investment quickly led to the diversification of their business from a nursery to a provider of greenery for the floral arrangements. So they started selling into a new major metropolitan market. They increased their weekly turnover of the farm by $5,000 a week. So a new annual income of between $150,000 and $180,000 that they saw the benefits from that investment through Farm Household Allowance. So it really transformed their farming enterprise. They adapted, they looked at where they could look at new opportunities. So for the hard times, there's also the Rural Financial Counselling Service that I mentioned, which sits in my division. And that really focuses on working closely with farmers on the ground in terms of upskilling and building financial resilience. And concessional loans are also available, which John will talk about. So we're really, in terms of the government and the government agency, we're supporting the readiness for the downturns through the Farm Management Deposit Scheme as well. And that's and also income tax averaging and other primary producer concessions. We've invested in programs to help farmers grow and prepare their businesses for difficult times, such as farm business resilience planning through the Future Drought Fund, climate tools, and demonstrating more drought resilient farming practices under the Future Drought Fund. Well, I'm glad to be here today to share the work we're doing. I really want to stress the importance of connecting and working together to build resilience. We've really seen through the Future Drought Fund where farmers and our community grants and initiatives are working together to improve the resilience. So we commissioned the market research which found that farmers who sought external advice and support from trusted advisors seemed to cope better through the downturn and the harder seasons. They treated their farm as a business and drought as a business risk. Farmers who didn't reach out seemed to feel less in control and be less ready to act. So I think today you'll really hear from the panel where it demonstrates in terms of the capability and the capacity of farmers working with all the available resources. We'll see great outcomes. Thank you.
Morning everyone, John Howard. I'm with the RIC, or Regional Investment Corporation, and as Mel described there, we're a federal government entity that provides concessional loans into ag. We were formulated in July of 2018, which, if you remember back then, was smack bang in the middle of that East Coast drought that went for a period of about 3 years, and the magnitude of the impact onto those farm enterprises and the strain it put on, what Mel was talking about there, the capacity of being farming entities being able to have the resilience to get through events of significant magnitude of that period, of that drought, really came to bear with the demand for our products. So if I just to give a bit of a highlight of where we fit into the broad scheme of things. So came into play, as I said, in July of 2018. Since that period of time, we've done over 3,000 loans, settled about 3.24 billion of those. They're across all areas of Australia, so we're national in our footprint. You'll see that 3 of the 4 loan products that we actually have there all need as an eligibility criteria an event or disruption to cash flows through a drought or a natural disaster or a market disruption or something like that. And that's where the farm investment, the drought loan, and also that AgBiz drought loan fits into play. The benefit of that, of our product, is the concessional nature of our loans. So when they're in period of need where cash flows are being constrained, it's a way of minimising cash outflows through the cost of capital or the cost of interest that they're actually incurring. So just if I move on to how does that benefit through to the customer base that we've actually got, and going and talking to them and getting a bit of research back is a key part of that. And I think the criticality of this comes through us when we're looking at the volatility in the climate and also the commodity price data that Neil showed to us earlier on. And the magnitude of that, especially since 2000, seems to have increased significantly, and therefore how do we help people manage through transitioning or from event to event is the criticality of where we're helping out. So we're definitely not the primary there, that's with the commercial banks. Anyone that deals with us actually has to have a commercial debt. We can't be more than 50% of it. So it's very much around how do you help transition through people and how do you help transition through those periods of need is where we come into play. And just some interesting stats on or information that comes back from our customer base there is really highlighted. If I look at the other one is, and I think this is a really important piece of information because it's not just the primary producer that experiences hardship through these events. When you come to the small regional towns and the flow-on effect that actually happens when you've got a constrained primary production sector, how that flows through into other segments of the economy and especially in regional areas is enormous. So we've recently undertaken a a economic evaluation of our loan product, looking at the flow-on benefit that actually comes from those, as expressed by gross regional product that you can see there. And the benefit that shows is, if you go back to the previous information where we've done about 3.24 billion in loans, the flow-on of benefit, as highlighted there, is higher than that. That also manifests through, though, to employment, which is so critical as we go through into those regional areas, and how that actually manifests through. So that's the other, in this conversation, it's not just about the impact of the primary producer that's an important one to consider, it's actually that broader regional community element as well. What's always a really good way of demonstrating, how we actually fit into play, and Bega's getting another mention here, there's some customers of ours, so Brodie and Kevin Game. Young people starting out into the dairy industry back in 2010. When it comes to impacts of events, you'll see in this one where they had a drought to start with in 17 to 19, then bushfires came through that area in 2019 and 20, and then just to top it all up, floods came through and were impacted as well. So again, the impact that had onto their cash flows, therefore when they reached out to us and were able to actually pick up one of our loan products, help them actually transition through, and the important part there was providing capital to do change to their operation to actually get through the next event. And in this example was where they were able to put in some an additional pit of it, therefore they were able to grow a lot more fodder, put that away and be able to get through events later on. So that's where we fit into play. I think the important message here is we're facing periods of greater volatility in climate, and a flow-on of that seems to be commodity price as well, and how we actually help good farmers transition through and manage through those events is a critical component of the longevity of the sector in total. But so thank you very much, pleased to be here, and I'll pass on to Christina. There we go.
Thank you, and absolutely a pleasure to be here today, and a real honour to be part of Australian agriculture. I'm Christina Hermanson, and I will, in my introduction, just highlight a little bit about our optimism around farmland investment, some of the opportunities that climate change presents, and then share a little bit on our ideas of nature-based solutions and how that adds resilience. But I really want to get to the questions, because I know there'll be a lot of good ones in the audience. So just as a brief introduction, Nuveen Natural Capital is the largest farmland asset manager in the world. Across farmland and timberland, we have $12.4 billion assets under management across 10 countries. We've been investing in farmland for 36 years, and here in Australia since 2007, with a very dedicated expert team, also integrated in regional communities. So, starting first, a very positive outlook on farmland investing. The chart you see here is looking at a very strong risk-adjusted return of a diversified farmland portfolio, and that's what's key from an institutional investment perspective. So you see in that upper left-hand corner, two different Australian farmland indices. The first from ABARES, it's excluding the smaller farms, and then ANREV, which is another index which really highlights institutional grade farms and does include more permanent crops as well. Relative to Australian government bonds, to debt, to equity, we have US farmland in here. It's normalized to the Australian dollar, so you see some volatility coming through there. It is a very strong addition in a diversified portfolio. And when I say that, that applies to all of you. You can have that in your super fund. As an Australian, I can have that if I'm in the US. Remember, we invest on behalf of our US parent, but also investors all around the world. In addition to that, from institutional investor perspective, farmland provides a good tool for inflation hedging. and it has a very low and negative correlation to other asset classes. So again, good robustness and diversification. Coming back to Australia and how we look at climate, I guess first and foremost, as a global investor, Australia is a really unique position in climate change and biodiversity. And we always think very holistically in terms of nature, climate, and people around our investments. So first and foremost, 50% of Australians' GDP, 900 billion Aussie dollars, does rely on a healthy environment. Also referencing some of ABARE's work, total factor productivity is increasing over time. I think what's interesting is looking at that climate-adjusted total factor productivity. And ultimately, beneath that, it's technology, it's practice changes, it's the innovation that you mentioned. And, I'm quite motivated by that curve in Australia. In addition, from a biodiversity perspective, Australia is off the charts in terms of uniqueness relative to some of the other large nations for the type of biodiversity we have to preserve and protect. Looking from a global perspective, how do we think about climate change and climate and nature have to go together? You'll see a chart there on looking at water scarcity by 2050. I think that's a very difficult thing, to model out to that time. But I think what you see on that map, probably nothing too surprising. So from a global trade flow, from a food security perspective, it's really important to keep that productivity curve going in Australia, but also thinking about those other areas that will have to step up and improve yields as well. And here within Australia, we look at assets. Obviously, if there is irrigated land, carefully looking at various sources of water, working with other partners to think about actually using artificial intelligence to think about, especially for permanent crops, if we get to 1.5 degrees, 2 degrees, what is the impact on the chill hours? What is the impact on the maximum temperature and average temperatures? And we look at that kind of data around the world as we're considering different investment strategies. And you'll see a little picture here below the globe. That's just a small example of a project we have in WA where there was more degraded pasture land, and we implemented a carbon project, but ultimately connected a couple of corridors and also have biodiversity benefits. So doing the right thing in the right areas on farm and creating some resilience through different revenue streams. Well, when I present, this chart is almost always core to the message, and it's coming back to a global level. Ultimately, farming, agriculture has to be part of a nature, climate, and productivity solution. So we know that we have, kind of competing ambitions around our farmland, around our practices. We want to reduce biodiversity loss. We are committed to close the greenhouse gas gap. But at the same time, productivity and profitability to keep those farms going. We've got to increase by 2050 from the 2010 baseline, 60% in calorie production, and not to forget 200% in timber. So farming has to be part of that solution, and nature-based solutions provides the opportunity to look at those practices more regenerative in nature, bring in more technology, and be able to implement biodiversity and carbon management practices around the landscape. And I can talk more about that. So I think I'll...
Yeah, excellent. A terrific scene set. Thanks very much for that. You're getting your questions in, and while you do that, and while put your hand up for a roving mic. Where's the mic? Can somebody point me to a mic? Sorry. You can rove with that. Can I just ask Neil Hughes, who's bringing his own furniture, can you tell us more, please, about? Have you got a microphone? You can lean it across. Can you tell us more about the Drought Early Warning System project?
Sure. Hello, everybody. So the Drought Early Warning System project, it's ABARES and CSIRO. It's about taking the Bureau of Meteorology's weather data and their seasonal outlook products and running them through agricultural models, translating them into agricultural outcomes. So the types of things that we've been talking about here, farm profits, but also crop yields and pasture growth information. So we've been busy developing a system that can produce all of that data on a 5-kilometre grid across Australia. There'll be a report coming out in the next month or so. And eventually, hopefully, a public system where people can go and point and click and get detailed information for particular locations. So I think it's relevant to today's topic because that kind of data is useful, potentially useful for risk management itself. So it can be informative to farm businesses and advisors to have a customised analysis of how much risk they face. Some of the kinds of charts that I put up here, but specific to their business. And it's also the kind of information you'd probably want to use if you were developing insurance products, particularly parametric insurance products. So we're interested in pursuing those applications as well.
Neil, we've heard a lot of criticism about the Bureau of Meteorology in recent times and, you know, famously sort of delayed its prediction of an El Nino and then it seemed to rain. What do you make of this and what role do you think forecasting has to play in farm risk management?
I think Jared kind of covered this pretty well yesterday. I think the BOM's been unfairly criticised. You kind of need to judge the BOM on the quality of their forecast, their rainfall and temperature forecast, which the last few months has been fairly reliable. They predicted a dry spring and we got a dry spring, and they were fairly open-ended about what summer could look like, and what we had was well within the range of what they were forecasting. People kind of latched on to the El Nino apparently. But there's probably some communication issues there to manage. But the BOM have been kind of thrown under the bus a little bit. But it does kind of highlight how important forecasting is, and particularly the forecasting that goes longer term. So the challenge with what the BOM are doing with their seasonal outlook is that it's kind of looking 3 months ahead. It has a lot of skill really for 1 month. But farmers want to know what's happening in 6 months and 12 months, and that's why they're looking at El Nino. And at the moment, there's a gap there. And there's not the BOM's problem. That's just no one can do that. No one in the world can forecast on that time scale accurately yet. But hopefully we will get better at that because it will make a big difference.
Yeah, and there are a lot of private providers who are assisting the Bureau of Meteorology in getting their information out. You want them to be well educated. You also want the media to be well educated, don't you? Because I think the media did latch on to terms that blew the situation out of proportion. I would say the ABC did a good job, but we were also using those terminologies, and I'm heading out the door. There's a question here, so I'll lean across as I read this first one. So, has there been any research into the longer-term profitability of farms accessing finance versus those not accessing finance in dealing with climate or price impacts? Neil, right.
Yeah, I'm not sure. I'm not aware of any. I'm not sure if anyone else on the panel wants to.
No, not specifically accessing finance, but I think that there's a lot of things that can be done on farm that don't require a lot of capital, which can help farms adapt to climate change. And some of those things we saw people putting in feedlots to bridge the feed gap, and also other things, just adaptations such as, zero till and things like that. We're seeing people fence waterways and put in tree projects out of cash flow. You can do it incrementally over time, and has a big impact over time, but doesn't necessarily require a lot of finance. And another thing with risk management and the supply chain is we're seeing more and more people take advantage of opportunities whereby they are prepared to enter into a supply chain arrangement. They've got a credential, sustainability credential. There's a few around in the livestock industry at the moment, and traceability programs with sugar, for example. The wine industry has some sustainability programs, and that actually gives people preferential access to the supply chain. So that's a way that people can protect their profitability on farm by getting that preferential access. May not be a big price incentive, but it helps with on-farm profitability. So there's a number of things that can be done that don't require a lot of finance.
Josie, do you want to expand on that? Because, what are some of the climate adaptations, strategies that your customers at NAB are engaging with?
Yeah, so we're seeing a lot of people scrutinise their inputs. So precision application of fertiliser, being smarter with water. So precision application of water, improving irrigation systems and making water in a dry climate go further. I think, we're starting to see people, as I mentioned, not only scrutinise those input costs, but also look at where their income's coming from. And another strategy that we're seeing is farmers consider the environment that they're farming in and whether that climate is suited to the commodity. So we're seeing people enter into more of mixed farming situations to perhaps hedge what they're farming. Obviously, we're seeing grapes move further south. We're seeing almonds come further south, and even into those more marginal areas, though, that you might say, oh, well, you can't farm there. But we're seeing carbon projects. So we're seeing, regeneration and income actually recognised as a potential for those areas that have traditionally had some cattle or sheep as income, but, not so suited to that. And farmers really, and other organisations, actually, I shouldn't just say farmers, but taking advantage of those other opportunities.
I'll go to Kylie Holmes's question from the floor. So we saw the farm predictor model. How will this be used by farmers to make timely decisions regarding mitigating risks and planning? Who'd like to take that on? Is that Neil for you again?
I'm not. So we've got to be careful about, over-promising with some of this modelling work. So I think there are applications within the industry, particularly for insurance, for risk planning, financial planning. It's not the kind of modelling that ABARES and CSIRO are doing. It will never replace what's going on farm. We'll never be able to predict what's happening on individual farms that well that we can be telling farmers what to plant and that kind of thing. So it's not a decision support kind of product in that sense. So it's more about longer term decisions, and it's more about informing people like banks, insurance companies and governments who are a long way away from farmers and need information about what's going on the ground.
Mel Brown, can I come to you with a question? So we've talked a lot about financial resilience, but there's also social and environmental dimensions to building resilience too. What does that look like?
Yeah, so the Future Drought Fund has a wide range of projects, and we're just developing the next 400 million with government now. But we look at initiatives with farmers and communities that can better manage through drought and future droughts as well. So it's really preparing, not just in drought, we're looking at preparing for future droughts. So some of these initiatives are around helping regional communities prepare for drought initiatives, so that's funded through the Future Drought Fund. We've also got the Drought Resilient Soils and Landscapes program. And we also have found that because resilience is about the triple bottom line, building economic, social and environmental capacity is really critical through the Future Drought Fund. We've got some great examples that we've used and worked with farmers. So Ian and Julie, who work in New England, they've got 2 farms in that area, and we worked really closely with them through a grant that we'd given the University of New England through the Future Drought Fund, and that was a coaching initiative. So it was working with them to coach them through, in terms of their soils, what kind of productivity, when was the best time of year for their cattle, etc., when to move into different paddocks. So it really helped them strengthen their mental health as well through that program. So we're offering a lot of key initiatives through the Future Drought Fund and really connect with other landholders. As I mentioned before, it's critical that farmers are working together to build that resilience and adaptation.
Okay, so further to the resilience, John Howard, question for you. So what role does the regional Investment Corporation, so play in helping farmers improve their climate resilience?
Sure. Where we fit into play is actually helping manage through and recover from events, and by having a lower cost of capital through there, i.e. a lower cash flows that they can actually put into building or developing, getting through those hard years, but it's also working with banks, enabling people to put investment into capital that actually has a long-term benefit to aid in that resilience that Mel was highlighting. So examples of that we've seen as the example with the game family that I had before with pivots. We see a lot of activity going with water infrastructure, a lot into the fencing side of things as well, pasture redevelopment and diversification. Depending on the region, there's where there's capital required to bring long-term benefit or change into a business operation, and we can provide a lower cost of capital, which helps increase their ability to actually initiate those projects, is where we come into play to help those things actually happen.
Yeah, so it might not just be drought.
Definitely not just about drought. Our farm investment loan covers it through other natural events, floods or cyclones or even biodiversity, fire, those sorts of things as well. So we've got a product that covers any of those events as a trigger, as an eligibility.
All right, grab the microphone, Christina, because this is for you. So from Justin in the audience, how can the Australian agricultural sector motivate investors across the value chain to invest in nature-based solutions, please?
Great question, and one I spend a lot of time thinking about. I think the key is, I shared the chart, the financial returns for a diversified portfolio demonstrated over decades. That's quite clear. What nature-based solutions provides for an investor is a third dimension, or regenerative ag alpha, the bonus, whatever you want to call it. And it allows them to work towards net zero carbon commitments, to participate in TNFD pilots and understand how the nature repair market is evolving. Now, the key, I think, to unlock that potential investment is transparency, aligning to external markets, ensuring Australia in particular will be ahead of the game in global trade. So a couple of examples of that: the Australian Agriculture Sustainability Framework, provides one common Australian framework, I think, is the key. To be able to look at holistically what are the practices. It's not just about carbon, it's about holistically sustainability. How will that then be implemented and measured? Investors also want to understand the greenhouse gas protocol. How are we measuring against that? Natural capital asset registers, and more detail around what the value of a farm means to society, how that's evolving over time. And again, the Task Force for Nature-Based Financial Disclosures, we've done several pilots around the world. We intend to do one here in Australia this coming year to really demonstrate what does that mean, how can you use that information to learn in your portfolio. And I hope to be here next year and say this unlocks more investment.
Love an insightful heckle. Thanks for that. So Abraham from the audience writes, what needs to happen in the insurance markets to make premiums affordable for farmers in a volatile climate? Neil?
Yeah, I can have a go at that. As economists at ABARES, we're obviously very much against subsidising insurance, because that kind of defeats the point. But there's definitely some things in terms of data that would help. Parametric insurance relies on accurate data, and the game is really about trying to predict what's going on at individual farms and reduce what they call as basis risk, or the gap between the data and what's actually going on the ground. So the work that ABARES and CSIRO are doing is kind of in that vein, but there's a lot more that could be done. Even if you look at weather data, we have a 5-kilometre gridded weather product from the BOM, but it's based on, in rural areas, pretty sparse weather stations. So, more accurate where the data would help. And then if you look at other parametric products like for price risk, again, there could be improvements in the quality of the price data for livestock that would support some of that. I think the other challenge just for the insurance sector is going to be climate change and being able to price these products based on history, which is a problem because we can't be confident that the history will repeat. So that's naturally going to force insurance companies to probably bake in a bit more into their premiums.
And a question as a follow-up to that has come from Shannon Guy down here. So some of the insurance premiums are unaffordable, and that becomes a transition risk, and it's starting to play out. Do you agree that the cost of insurance, people are not choosing to insure as those premiums go up?
Yeah, well, I mean, the one thing you can say is that the price of insurance is also a bit of a signal to people. So if you look at like flood risk, if you can't afford flood insurance, it's probably a signal that you're in an area where there's going to be a high risk of flood and maybe you need to move. So high prices of insurance aren't always a problem. Sometimes they're a legitimate representation of the risk, and they're trying to... That's why subsidising insurance and just making it cheaper is not kind of the solution. But, if you can find a way to reduce the cost of providing insurance, then that's useful.
I think America thinks that that's a terrific way to insure the farms and buy their votes, is to subsidise the insurance. A question for perhaps a couple on the panel, Mel and Josie. A question from Brendan. How do we get farmers to leverage their $6 billion in farm management deposits, the FMDs, for better resilience? Mel, do you want to take that first?
Thank you. Thanks, Brendan, for that question. So we did see a kind of additional national level of farmers made larger than normal downturns from their FMDs. So they did pull it out between 2019 and 2020, of course, to help them manage through drought. We do work with farmers in terms of the FMD around looking at it broader than just for drought, and I think we've seen that they've really invested significantly recently into that FMD, and whilst it is around preparing for drought and having money in there to actually help them through the bad times, we are seeing that it will assist with drought recovery and resilience. So I think farmers are really making those decisions. They're seeing it through the government's investment through the FDF, that it's there to actually help prepare, but we can actually use the FMDs to look broader across farms to build that resilience.
Josie, is it something that you can talk about? What people are using their deposits saved away?
I mean, they're a great tool to insulate against those times. I think that there might have been a part to the question, I don't know if it's moved, about using it to natural capital, and I think I think that the research that's happening out there at the moment with Farming for the Future, for example, to have a look at building natural capital and the benefits of having that in the farming business and the associated financial performance and resilience. The more we learn about these things, the better we can understand and have conversations about the benefits. So I think it's partly the research, understanding, and I think partly as well, deploying FMD into natural capital and resilience. I think that for sustainability, for example, I think the market is going to start determining that a little bit. They're going to start asking for some of these credentials. So when the market starts asking for them, that's going to influence farmers to want to invest.
Question for Christina, please. How will we unlock more capital from institutional investors into nature-based solutions and farmland in general?
Yeah, I think in the last question I did cover quite a lot of that, but I think it is we think of evolution of how we think about farmland management, and that's happened kind of naturally, and I think it's happening on corporate farms, family farms we're talking about, but it will be the demonstration of what we say of resilience. First focus on a profitable, productive farm, bringing more ag technology to that farm and demonstrating that through data. It will be establishing carbon projects, taking some of the administrative burden out of getting those registered. Anybody that's done that before will be nodding their heads. And it's a good process, and we're thankful for the market. And seeing the nature repair market, come to life. And there again, if you're looking at investing globally, I think Australia has a very unique opportunity, also with the Nature Positive Summit coming later this year, to get that moving.
What's that called? Nature Positive Summit.
Yes,
Where is that being held?
in Sydney in
Great.
October.
October.
Global summit. Yeah.
Great, thank you. A question for John. Is the RIC getting more first-generation farmers into ag? It has loans for this purpose. Are they working?
Oh, that's definitely the feedback that we're getting. If you look at our loan portfolio this year, it's probably half of the inquiry is for that AgriStarter loan product. It's the hard period of getting into it, a first starter into ag, and therefore we're seeing how in those it's harder now because land values have been going up and it's bigger obstacles, and therefore they also through those early stages is the cost that they're incurring. So where we fit into play, again, we can't be more than 50%, so it's very much with the relationship that they've got with their commercial banker, but how can they lower that cost of capital through having a component of their debt being of a concessional nature that we provide. We're absolutely seeing an increase in the demand of that product, and it's probably half of the demand that we're seeing in this current year.
Gosh, that's very interesting.
Yeah.
Just this morning, it occurred to me that one of the questions that comes to mind is that the value of farmland has increased so dramatically in the past, I'd say, during the low interest period. So 3 or 4 years of that. So perhaps to the NAB and to Rick, with that dramatic rise, what are the risks, especially when it comes to, finding solutions for the climate that we're trying to?
Yeah, well, it comes down to the 3 C's of credit. So, do we have enough security for the loan, and what does our servicing capacity look like as well? And so, we have seen the market soften in the last 12 months. We've seen, a lot of really strong prices out there, but, the tempo that we experienced when interest rates were low and commodity prices were good and the weather was good, that's really slowed down now. So I think that there is still very strong demand for the right assets, and we're seeing, natural capital appeal to some people. We're seeing, the neighbour's farm appeal to others. And in situations like that, people are still prepared to spend. You achieve things like economies of scale, and you can diversify your income stream. So depending on the situation, there's still people who are very active in the market, and we're still seeing prices hold.
Oh, I concur, the 3 C's. We apply exactly the same sort of principles, or anyone that's doing a loan. They're there to be repaid. So therefore, the nature of the entity, the nature of the people that are actually doing it, the proposition that they're working towards, and the security that they've got with them, all comes into play. So, we just fit in with understanding all of that, and also understanding, and we see it across all segments, that challenge of intergenerational, and therefore the challenge of bringing new people or younger people actually into it is the recognition from a federal government perspective of why we have a loan product, just to lower that cost of capital, but the same rigour in where it gets applied holds true, because it's a loan product that's there to be repaid.
Well, I get the sack at the ABC because I've gone past the news. We've just completely missed the news bulletin. So while we've got, perhaps a minute each to finalise this panel session and wrap it up, it has flown by. So, Neil, a final mention, a point forward?
Oh, I think the only other thing I didn't say much about was that looking at the industry-wide perspective. So the government have a lot of programs looking at farm risk management. But it'd just be interesting to think a bit more about, how we can prepare as an industry on a national level for extreme shortages, and thinking about, the worst case scenarios of when we might need to import commodities and what our plans for that might be. Yep.
Christina.
Climate and nature are a huge opportunity. They're unique in Australia, and we in the industry have decades of track record of being innovative and ahead of things. Bringing markets like carbon and nature repair to life will make a significant difference. And cheers to Australian ag in that picture.
Nice, thank you.
It's a magnificent sector. It's the opportunity that's there. Yes, there's volatility, there's risk that's to be managed that's increasing, but I think a consistent theme that we were hearing about yesterday was about food security. And being in a sector and an industry that is servicing that basic human element is one that we're very cognizant of, and therefore with understanding that there's risk and volatility in climate, commodity prices, etc., that's part of the challenge and the nature. So how we actually put in the appropriate risk management facilities to manage through those as we're producing that food security is a key part that is always front and centre of what we think about anyway.
Mel Brun, thank you.
Yeah, so I guess for us from government, a key priority for us working with farmers is through sustainability, resilience and climate. So we're seeing climate risks greater and greater. We've got the Ag and Land Plan that the government's been working on, which is key in terms of linking in with the Future Drought Fund and building that resilience for farmers and capturing the climate adaptation as well as really critical, and will build the resilience for farmers in moving forward. So we've got the next $400 million for the Future Drought Fund, which we're working through now, and we're hoping to come out very soon with what those programs will look like.
And NAB, one of the biggest agribusiness lenders in Australia.
Yeah, so APRA, our regulator, did a bit of a climate vulnerability assessment of the sector and across banks, and they found that the sector, whilst it will experience the impacts of climate change, that on the whole, farmers' ability to adapt and transition means that there won't be, any sort of adverse impacts across the sector. So I think that's what we're seeing, and that's what we're all here to support as well. So, yeah, it's a positive news story.
So there's time, I suppose, to collar our guests, our panellists in the breaks, if I let you have one. So I think we should thank them now and go to our next session. Thank you.